the inflation again coming back with all of you know, WPA has remained in double digit throughout the first 9 months this fiscal. Where do we see the inflation panning out in FY23? Is it inflation good or bad? It is bad for the consumer. Is it good for the government? Where do we see whether the investment demand will revive or not? So these are some of the questions which we are trying to answer in this economic outlook. So Sunil, all of you know, so we'll be making a brief presentation of say 15 to 20 minutes, and then post that we will have question and answer session, and which will be open for all. So over to you, Sunil.
Yeah, thanks, Devendra. A very good morning from my side to all of you who have joined the call. Let me first share my screen. Yeah, I hope it is visible.
Yes, it is.
Okay, so the way we are looking at the fiscal year 23 is what is summed up in the title, A Meaningful Recovery. We know that after a bad fiscal year 21, as per the National Statistical Organization's advanced estimate, GDP grew at 9.2% in fiscal year 22. So obviously, a growth of 9.2%.
Sunil, your voice is cracking. You can, I think it will be better. You can switch off your video, and then maybe the bandwidth issue will be resolved.
Dr. Sinha is reconnecting.
Yeah, I think there is some issue with his connection.
Dr. Sinha, I will switch off your video just in case.
Is my screen visible now?
Yes, it is.
Just let me make it full screen. Yeah, so I was just trying to say that whenever we make an assessment about economy, one of the better ways to look at the economy in these volatile times is not means that just before the pandemic struck us, and try to see that from that perspective, then obviously fiscal year 22 largely appears to be a year where whatever ground has been lost in fiscal year 21, that got recovered. So when you try to compare instead of looking at YOY growth over fiscal year 21 in 22, if we look at the FY22 GDP growth on the FY20 base, then the actual GDP growth turns out to be just about 1.3, 1.4%. However, on a YOY basis, we see that economy has grown at 9.2%. So keeping with that theme, we are looking at fiscal year 23. And when we look at fiscal year 23 from that perspective, then to us appear that while 22 could be more classified as recovering the lost ground, FY23 is from that perspective will be a year of meaningful recovery. So that's why that's the broad perspective that we have for fiscal year 23. But before I get into that, a quick glance through how the COVID 2.0 and COVID 3.0 has given some bit of pushback to the recovery. I mean, this is just a graph to give you an idea as to how things have been happening after the COVID 2.0 in the month of April, May. Last year, the cases started coming down. Thereafter, they remained pretty flat. But as soon as we entered the new year, once again, the cases have started shooting up. Almost in a similar manner, the way it happened immediately during the second wave. However, the good part is that the vaccination is progressing, and a fair amount of population has been vaccinated. But as many of us realize that even after double vaccination, we are not safe from COVID. We may still be infected by COVID. Though generally it has been seen that the people who are infected, their condition do not turn out to be severe. So that's another positive. But nevertheless, disruption has happened. So, in terms of Google Mobility Index, if you see the latest episode, then the mobility has really not gone down the way it went down either during the phase of the first wave of COVID, and even to a large extent during the second wave of COVID. I mean, some bit of impact has happened, but largely things are better in terms of mobility. And also we know that restrictions imposed by governments have not been as stringent as they were in the first and the second wave. But the impact on economy is still very much visible. Look at power generation. It is still fluctuating almost where it was, in terms of growth, I'm saying, where it was, immediately after the COVID lockdown. Power consumption also has shown some bit of uptake, but then again, the growth has fallen thereafter. So is the case with the fuel consumption, freight traffic, passenger. I mean, all of these have been, which clearly indicates that there is a fair amount of uncertainty and unevenness in terms of growth when we look at this high frequency indicator. And it is clearly indicating that there is still not much stability in the economic recovery. I mean, economic recovery is happening in bouts, and then suddenly it goes down. And this is, is also getting reflected in industrial recovery. I mean, industrial recovery, though, is happening, but it still hasn't reached the level where it was before the COVID hit us. In other words, if I take the IIP index of February 2020 and try to see where the total output of latest number which is available in November is, then you can see that though we are approaching very close to that, but we are still, a bit lower than that. And from use-based industry like primary goods, capital goods, intermediate goods, consumer durable, non-durable, in each of these categories, we see that, things may be improving, but it is still lower than the pre-COVID period. However, when we look at the infrastructure industries, there things are slightly better in the sense that many of these segments of infrastructure industries like crude oil, natural gas, petro-refinery, fertilizer, steel, in all these, the production has recovered to the pre-COVID level, and in few cases they have gone beyond that. But then again, coal, cement, electricity are the areas where still the overall production is less than the pre-COVID level. When we look at a slightly more disaggregated level in terms of what's happening across different sectors of industry like beverages, textile, the paper products, chemical products, and so on. So again, we see that, the green lines, which indicate that the production level has crossed the pre-COVID level, are less in number, and more industries still have to go beyond the level where they were before COVID hit us. So with this backdrop, we just looked at the fiscal year 23 or the prospects of fiscal year 23. So this is our forecast for fiscal year 23. I mean, we are expecting the real GDP to grow at 7.6% in fiscal year 23. And similarly, if you look at different components, almost all components, whether agriculture, supply side, agriculture, industry, services, we expect that all of them will continue to do or continue to recover. So even though YOY growth for F22 is high, which simply means the base is high. But despite that, we are expecting a significant growth in fiscal year 23. Even from demand side, we expect all of these components, whether it is consumption demand, investment demand, to do reasonably well. But as I said, the better perspective would be that if we try to look at these numbers, not from what's happened, what kind of a growth it is showing over 22 or 21, the better way to look at would be that where they are vis-a-vis fiscal year 20. So in all these cases, we clearly see that fiscal year 23, because 22 was more or less recovered the ground lost in 21. Most of the addition that is going to happen in 23 will be on the positive side, means that these numbers, even in absolute or level terms, will be higher than FY20 level. But another perspective is that suppose suppose COVID had not happened, then where economy would have been. And now that we are expecting 7.6% growth in 23 on top of 9.2% in fiscal year 22, are we back on track, or are we still somewhat away from the usual trend growth? So, when we look at the number of fiscal year 23 GDP number and try to see from that perspective, then it is clear that had the COVID not happened, and now that the COVID had happened and we have 2 years of successive growth, but still in fiscal year 23, overall GDP will be 10.2% lower than the trend growth rate. So that's another perspective or another way to look at the whole issue of growth in fiscal year 23. Now, I said that there will be a recovery in fiscal year 23, which will be more meaningful in the sense that it will be, for the first time, it will be higher than the level that we attained in fiscal year 20. But let us look at the different demand drivers, how they are behaving or they have behaved over the last couple of years and in the last 2 years also, because that will give us an idea that fiscal year 23, if there are any challenges for fiscal year 23 and onwards. Now, if we look at the entire story from demand side and look at the largest component, which is the private final consumption expenditure, mostly known as consumption demand, then, if you take an average of 21 and 22 in terms of growth, then the growth is still negative 1.1%. It's not that the private final consumption expenditure has recovered. In fact, this is primarily because that the fiscal year 22 GDP estimate, which National Statistical Organization has provided, if you look at the number 6.9% YOY terms, it looks a healthy growth. But even with this 6.9% growth in FY22, in level terms, the private final consumption expenditure in FY22 is still lower than the private final consumption expenditure level that was attained in fiscal year 20, that is pre-COVID period. So that's will give you another perspective that the largest component of demand side driver, which is the private final consumption expenditure, despite a healthy growth of 6.9% in fiscal year 22, hasn't recovered the lost ground. So obviously, when we'll move into the fiscal year 23, there will be a recovery, and from when we'll compare it with fiscal year 20, there will be a meaningful recovery in private final consumption expenditure. But the issue here is that this is the largest component, and this is still not showing a recovery which can contribute significantly to the overall growth. So that, in our view, will be a challenge. And I'll tell you why. If we look at the consumption slowdown more from the perspective of income growth, then the two proxies that we looked at was the rural wage growth and the urban wage growth. Now, whether you look at the rural wage growth or urban wage growth, in both these cases, you will see that firstly, the both rural and urban wage growth, which were rising till about, say, April, May 20 in case of rural wage, and about, December 19 in case of urban wage. The wage was growing, or wage growth was there, but thereafter both of these components have started showing a much slower growth in the wages. Firstly, this in itself is something which is going to impact the overall household consumption. And then on top of that, if you look at the rate of inflation, the way it has picked up, which is the red line in both these graphs, in many months have been actually higher than the wage growth, which simply means that their real wages had turned negative, and that has obviously serious implication for consumption demand. Well, one may articulate or argue that, look, I mean, these were the bad phases where COVID was playing out. So naturally, you cannot expect the wage to grow. So as soon as the recovery happens, this wage growth will be back on track, and maybe that will help. So, it could largely be classified as a cyclical issue. But I think, the household consumption demand is down and out, not simply because of the cyclical factors. It is also down and out because of some structural factors, which is what this particular slide is trying to demonstrate. If you look at the household savings as a percentage of GDP, it was 23.6% in fiscal year 12, and since then it has dropped to about 18% in 16, and thereafter it is still hovering in the range of 18-19%. On the other hand, if you look at the leverage of household, means that how much personal loan they have taken as a percentage of GDP, then clearly it has risen from 9% to 12.5% in 20. And again, fiscal year 20 means that we are still talking about the pre-COVID period. One can well imagine what would happen in the post-COVID period. And these are the issues which clearly indicates that the kind of consumption demand we saw from fiscal year 12-13 onwards till about its collapse in fiscal year 20, from roughly around average 7% down to 5.5% in fiscal year 20. It looks like that a large part of this consumption has not happened because there was significant amount of income growth. A large part of it has happened for two reasons. One is that households kept dipping into their savings to maintain their consumption, and wherever it was not possible, they have even leveraged themselves by borrowing from the bank or non-bank sector to maintain the consumption level. But it's unlikely that, once the COVID or COVID-related issues have hit them, they will continue with this trend. So that will have, again, significant impact in terms of a revival of consumption demand. Now, let us look at the Capex. Capex shows a growth of 6% during fiscal year 13 to 19. It dropped to 5.4% in 20, and for the last 2 years, it has averaged 2.1%. The larger story here is that a large part of this Capex has actually been supported by, the government Capex. Government Capex has been supporting the overall Capex in the economy, and in lately, I mean, fiscal year 21, 22, the support has even been stepped up further by the government. So clearly, government is willing to, play the role of anchor so far as, or do the heavy lifting so far as Capex is concerned. But I think the real issue is that no matter how much government Capex goes up, both center plus state together accounts for only 12% of the overall Capex in the economy. So, the ability of government, despite a stepped up Capex, to move the needle so far as Capex growth is concerned is very, very limited. A large part of this Capex actually comes from household and private corporations. And both of these major investors have, faced headwinds. While households mainly invest in, real estate, the corporates mainly invest in machinery and equipment. So households have been facing the headwinds of real estate, which is still in a difficult situation, though some bit of recovery is visible there. And so is the case with the capacity utilization. And also there are, supporting stuff that has been happening in the economy. I'll come to that, the exports piece and the PLI scheme, which has been announced by the government. So even though at an aggregate level, the capacity utilization is still not gone beyond 75%, it is still less than 70%. But there are select industries where capacity utilization is inching towards 80%, 85%. Say, for example, in steel, cement, and some of these sectors, capacity utilization have gone up, and the large corporate players have already started announcing their new Capex plan. But we will certainly see some revival of private corporate Capex, which were down and out for quite some time in fiscal year 23 and onwards. But much would depend upon the overall recovery, because if the consumption demand does not pick up, which I elaborated, why there are challenges, then again, these capacity increases will run into trouble very soon. But at least in the interim, it looks like that the support is mainly coming from stepped up exports, which is what, and plus the PLI schemes, where government has announced substantial, support, which effectively reduces the cost of capital for a large number of segments where PLI schemes have been announced. So if one looks at all of that, then yes, even our discussion with different corporates are indicating that for last couple of years, simply not looking at Capex. Now at least they have begun to talk about it, and in some cases they have even started taking the initial step to undertake Capex. This is the one that I was hinting at when I was talking whether private Capex can revive or cannot revive. Look at the exports. I mean, exports had been facing serious headwinds in the last decade. I mean, in fact, after the global financial crisis of 2008-9, there were support coming from different policy measures. So, the exports, global exports remained buoyant till about 12, 13, but thereafter, because of sentiments turning against the globalization, the exports faced a serious trouble. And then, different kinds of trade frictions emerged on the global platform. And all of that kept the Indian exports fairly down and out. And in fact, in fiscal year 20, the overall exports of goods and services in terms of growth was negative. However, what we have seen is that towards the end of fiscal year 21 and the beginning of fiscal year 22, there was a sudden change. And this change is that if one looks at India's merchandise exports was actually on a monthly basis had never crossed 30 billion. If you look at the monthly data of merchandise exports, then it has always remained less than 30 billion. For the first time in March 21, the Indian exports on a monthly basis crossed 30 billion. And since then, it has maintained that momentum. And month after month, they are clocking merchandise exports growth of more than 30 billion. And even for the latest month of December, the merchandise exports is somewhere close to about 36, 37 billion. So this is a very, very significant change as compared to the past in terms of what's happening on the merchandise exports. And the other good part of this merchandise exports is that although the petroleum and petroleum products are still the largest component of our exports, but a fair amount of this growth as well as the level of exports has actually come from the exports of the engineering goods. And more engineering goods getting exported means that some of the idle capacity of manufacturing sector is now getting utilized. And if this momentum gets maintained, then clearly, this itself will catalyze the manufacturing sector to come forward and undertake Capex, about which I just talked about. So some bit of that is getting reflected. And if this continues for some more time, probably we will see more acceleration in the Capex. And the favorable fact is that after a fairly long gap, that even WTO has been pretty optimistic, or has become fairly optimistic about the global trade growth. In fact, their forecast for 21 is 10.8%, and even for 22, they are expecting 4.7% growth in the global trade volume. So this clearly indicates that some of the protectionist measure, which had become fairly prevalent and deep-rooted in advanced countries, are somewhat on the mend. And maybe this is what is helping the exports from not only India, but many other emerging economies to take it forward. So with this, the last demand driver, of course, is the government final consumption expenditure. And this is something which has been pretty steady. The 13-19, we see that it was 5.8% growth. In 20, it recorded a growth of 7.9%. Although for fiscal year 21-22, all of us generally believe that government has come forward and it allowed the fiscal deficit both in 21-22 to go up to record levels. I mean, 21 fiscal deficit 9.3%, 22 budgeted at 6.8%, which simply means that government is supporting or spending a lot. But from a historical perspective, if you look at, then it is still on the lower side. I mean, despite this kind of deficit, the overall government expenditure growth is still on the lower side. Our expectation is that given the bandwidth government has, it's unlikely that government will like to kind of go for a fiscal consolidation immediately. They may continue, to whatever extent possible, it will continue to support the growth, because growth as of now is still on the shaky ground. They still haven't reached a level where it could sustain. So with this, let me quickly look at the kind of support that government is expected to provide to the overall growth. I mean, our expectation is that even in fiscal year 23, though the overall fiscal deficit as a percentage of GDP will be lower than what it was in 22 and 21, but nevertheless, it will not reach to a level which had been the government's target, which is 3.5%. They will still like to support the current recovery, and they will probably, keep it around 5.8 to 6% of GDP. Now, the real issue is that if government continues with this kind of a fiscal deficit, then the quantum of borrowing that government is going to do in the capital market will continue to be very, very large. Although our estimate shows that the net borrowing will be somewhat lower than the last 2 years, but gross borrowing probably would be of the similar order. So such a large government borrowing program, if you try to combine it with, what's happening on the inflation front, the inflation, despite still being less than the upper band of RBI's tolerance level, but if you look at the trajectory of CPI inflation, maybe over last 1.5 years, then mostly the CPI inflation, even though it crossed the band only in the month of May and June, and has largely remained less than that since December 20. But it is very close to the upper band, means that inflationary pressure is simply not going away. And part of the reason is also that apart from the supply side disruption, which have led to price increases, there have been a reversal in the commodity price cycle in the global market, which has resulted in significant cost pressure in the manufacturing sector. And increasingly what we are seeing is that the manufacturing sector is no longer willing to absorb the increased cost. They are increasingly passing on these increased costs into the output cost. So as a result of that, even the core inflation, which was, down and out for quite some time, are now close to 6% and thereabout. And it's simply not coming down from that level. And if you look at the WPI, which is somewhat more closer to producers' price index, then you can see that what kind of inflationary pressure, the manufacturers and the producers are facing. I mean, in their case, the inflation is in double digit for quite some time now. I mean, from April, May onwards, consistently the inflation is in double digit. And as the manufacturing sector faces higher input costs, they are gradually passing it on, and which will continue to put pressure even on CPI inflation. So if one looks at, the three pieces, firstly, the large government borrowing, then sustained inflationary pressure, and the recent, stance of the government, RBI, where RBI was maintaining liquidity in the range of 6 to 8 trillion Indian rupees for quite some time. But in the last few months, we have seen that that excess liquidity has dwindled significantly. And now mostly it is in the range of 2 to 3 billion or even less than that. So, if you combine all of these, lower liquidity, higher inflation or inflationary expectation, large government borrowing, suddenly there is a pressure on interest rate to rise. And that is what has begun to reflect even in the GSEC yield. I mean, the GSEC yield, although had been, moving upward after April 21, but it stabilized somewhat in the middle till about September. And from September onwards, again, it is showing a rising trend, this green line. And since the policy rate is where it is, the spread is almost rising in the similar way, the way the GSEC rates is going up. Means cost of borrowing in the economy is now inching up. And so clearly the window which almost everyone utilize, large corporates, government, as well as even small and medium enterprises of low cost funds, probably will now give way to the cost of borrowing going up. And this is clearly getting reflected even in the corporate borrowing. If you look at the corporate borrowing, again, the spreads, which due to the aggressive monetary loosening had started coming down, the spread vis-a-vis the policy rate has now again started inching up here. And even, even in the lower end, though the movement has been, stable for quite some time, but it's showing that in more recent months, even at the lower end, where the cost of borrowing has fallen to even lower than the policy rate, have now risen above the policy rate, and that's why the spread is now in the positive territory. That means it has moved beyond 0 basis point. So I think broadly that's the story that we see for fiscal year 23. So I'll stop here. Devan, back to you.
Thanks. Thanks, Sunil. There's already a question on Q&A box, so I will start with them. So Sunil, the first question is from Megha Bahari. And the question is on export demand apart, was there anything in the domestic government policies that has helped lead to this increase? So is it purely the global demand play, or there's something which, according to you, like the government policies, which has helped in this exports performance to be at this level?
Well, a large part of the spurt in exports definitely is due to the spurt in the global demand. There is no doubt about it. But government has been trying to support exports through different measures, policy, interest subvention and stuff like that for a number of years. I mean, 14, 15 onwards, these policies were in place. But the problem was that since the entire global landscape has changed to such an extent where trade frictions, say, Trump in power, constantly getting into trouble with China, Europe is also somewhat looking inwards. So there was a overall global environment which was not very conducive for export. So some of these policy measures, despite being rolled out, really did not made too much of a difference to the export. However, in the last one and a half year, we have seen that many of these posturing, particularly after Trump going away and Biden coming in, are no longer there. So the overall global trade environment has improved significantly. And this, coupled with the fact that most of the advanced economies gave huge amount of fiscal stimulus to their domestic economy to prop up the demand. And a large part of this fiscal stimulus have resulted in higher income for households, particularly in US. So what they did was that whatever additional money which came to them. Am I audible?
Yes.
Yeah. So they use that for, purchasing items which they have been wanting to. And many of these are consumer durables and stuff like that. So that is what has helped Indian exports to suddenly pick up, and till date, they have been able to sustain it. So one of the question would be that when the fiscal stimulus eventually gets wind down, will the exports get impacted? Certainly it will be, no doubt about it. But I think since the global environment is much better, the Indian exports will be able to find newer destination and newer ways to sustain these demands. So some bit of impact will be there, but it's unlikely to go back to the levels that we had seen in say year of 16, 17, 18 and so on and so forth.
Okay, thank you. Sunil, next question is from Mukesh Jagota, and his question is: can rise of global inflation risk nascent global recovery and push normalization back by a few quarters?
Yes, global commodity is having an impact. There is no doubt about it. And as we demonstrated, that there is every likelihood that the global commodity prices will not only translate into higher inflation, but it might actually lead to tightening of policy across the globe. If that happens, then certainly we will be impacted because capital inflows will get impacted. Our market valuation will come down. Raising money through capital market will be less attractive because the kind of valuation you are having now may or may not be there. In fact, taking the cue from the fact that Fed may actually go for interest rate rise very quickly. The stock markets have tanked. So all of these will have a cascading impact. Apart from the fact that manufacturing, if it continues to pass on the increased input cost, and then on the other hand, if the household consumption demand continues to face a challenge, then demand recovery will be a problem. So certainly, the recovery which we are expecting may get impacted. So net, the situation is that while there is very little upside to the demand recovery, there are more downsides to the recovery given the way things are on the inflation front.
Thanks, Sunil. Next question is from Pallavi Nahata, and she wants to know about increase in debt to GDP. So Pallavi, it's likely that based on the deficit and the borrowing requirement, the gross borrowing and net borrowing, there may be an increase of around 3 percentage points. But all will depend on whether when government does OMO, what kind of bonds they are purchasing and what they are sending. So they are selling in the market. So there may be a chance of roughly around 2 percentage point increase, 2 to 3 percentage point increase in debt to GDP ratio. Okay.
And let's also look at government had announced the SAP 2.0, where they had RBI had earmarked 1.3 trillion rupees for OMO, basically to ensure that the rate of interest does not rise, whereby the cost of borrowing for government starts inching up. But despite their best of the efforts, the other macro variables, the way they have moved, has eventually resulted in a scenario where GSEC rates are no longer 6.2, 6.1. They are now 6.5, 6.6. So the cost of borrowing is going up. And so, the point which Devendra is making is, absolutely clear.
Okay, thank you, Sunil. And Mr. Manoj Kumar has his hand. So sorry, Mr. Manoj Kumar. Manoj, I missed it. So you can go ahead with your question.
Thank you, sir. Thank you. And a very good morning, Mr. Sunil and Mr. Devendra. And thanks for this wonderful presentation. So you are looking for this meaningful recovery, like expecting this 7.6% growth for the next fiscal year. But from you also said, like, on the consumption front, we are still not at the pre-COVID level, and probably for the consumers, the meaningful recovery is still far away. So my question is, what are the risks you are seeing to your growth projections of this 7.6%? One, and secondly, what is the inflation trajectory you are seeing for the next fiscal year, looking at the rising global crude oil prices and other commodity prices? and the widening gap between the WPI and the CPI inflation? And third, what is the your expectations from the budget and the RBI going forward? Thank you.
Look, let me take the last question first. I mean, as I said during the presentation also, we expect both government and RBI to support the growth recovery, which simply means that firstly, government will not be in a hurry to move towards fiscal consolidation, which simply means that we will continue to see a significant amount of fiscal deficit even in fiscal year 23 budget, essentially to support the growth. Even though I showed you that the inflation trajectory, whether you look at CPI or look at WPI, either way, it's on the higher side. And this is certainly fueling the inflationary expectation. RBI is one of the key job of RBI to anchor the inflationary expectation. Now, if RBI has to anchor the inflationary expectation, then obviously the immediate course of action is to reverse and start raising the policy rate, which we have seen RBI has resisted so far. And my own view is that RBI will resist that at least in the near term, simply because the overall recovery is still fragile. And on top of that, off and on, the bouts of COVID are making it even, the recovery even more uncertain. So both RBI and government will be fairly supportive of the recovery. And so, I don't see much of the policy level changes happening anytime soon. Now, coming to your other question relating to the commodity price cycle and its impact on the economy and challenges to the economy. Yes, there are a number of risks. First and foremost, of course, is the COVID, because as and when many of us start believing, and in fact, even the policymakers start believing that, the COVID is now coming to an end, we experience a new wave of COVID. So that certainly is something which is a big risk and will continue to play on the economy till the time the war against COVID is won. So that risk will be there. Then apart from that, the other major risk, of course, is the inflation, because inflation, besides eroding the purchasing power, which in turn will impact the consumption demand, also will be making the investment piece, which is apparently now on the verge of recovering, particularly the private corporate investment, may also get impacted, because most of these Capex does get funded via debt. And if cost of borrowing goes up, means that the entire calculation or IRR of these investments will face challenges. And so then again, many of these corporates may start thinking, is it worth spending or undertaking investment with a higher cost of capital or not? Because if demand is still not visible, cost of capital is going up, and the macro environment is also not conducive, then what is the whole idea? So these are, in my view, are the challenges which are very much there. But exactly how they will pan out is difficult to say at this juncture.
Sir, if you permit me, to ask a supplementary question. So what is the average CPI level you are seeing for the next fiscal year, and how much rate hikes do you expect from the RBI?
Well, for the next fiscal year, I think I showed one of the slide where we are expecting
4.8.
4.8, and the reason is that even though the prices of oil and many commodity prices are still at elevated levels, but the question is that they are not going to move up from here of the same order as they did last year. So the delta will be much lower. And this delta is what gets captured in YOY growth, or the way we calculate, or the way inflation is calculated. So since the base of 22 in terms of inflation will be relatively high, the overall average inflation in fiscal year 23 to that extent will not look as magnified as it was in fiscal year 22. It will be much lower. So as Devendra said, we are expecting an average retail inflation of 4.8% and wholesale inflation of 5.7%.
Thank you. So the next question.
Thank you.
Welcome. Next question is, there are two questions from Deepak Mondal. They both are interlinked. So basically he wants to know fiscal deficit in FY22 and FY23, and when do you see the fiscal deficit will come down to 3.5% to 4%, or is it the new normal?
Will you just repeat the question?
Yeah, the deficit level in FY22 and FY23, and the next in the same is by Deepak. Next question is, when do you see the fiscal deficit coming down to 3.5% to 4%, or is it the new normal? So basically, I believe he's asking, is the high deficit is a new normal?
Look, so far as FY22 fiscal deficit is concerned, I guess we have put our view already in the public domain, because, the way the tax and non-tax revenues have panned out in fiscal year 22 is much better than what budget had expected. So net, the both tax and non-tax revenue collection have been fairly robust, and we all know that there will be a significant shortfall in case of disinvestment. But nevertheless, despite the shortfall in the disinvestment, our estimation shows that, and also the government has not been very aggressive so far as expenditure is concerned. So taking all of these into account, our estimate shows that actually the fiscal deficit in 22 would be lower than the budgeted estimate of 6.8%. We have estimated it to come in at 6.6%. So that's so far as fiscal year 22 is concerned. But fiscal year 23, as I said earlier, given the fact that recovery is still very fragile and requires fair amount of policy support, government would not be in a hurry, to roll back its fiscal stance and immediately start targeting 3.5%. So, in my view, the whole fiscal consolidation process is unlikely to be something which will be done in a hurry. It will be a slightly long-drawn process. So the fiscal deficit to 3.5% will be at least 4 or 5 years away from now, is what my view is.
Since we are already 3 minutes, I had then exceeded time by 3 minutes. So there are 2 questions right now. So we'll take it, and post that if there are any question, you can post it to either Ankur or bilaterally to either Sunil to me. So there's a question by Bani Kinkar Patnaik from FE. I hope your question will be after this. So we'll take your question also since you have raised hand. So Bani's question is, given the elevated inflationary pressure, when do you expect RBI to start raising interest rate? And then there's a follow-up I will ask once after your answer to this question.
Yes, the inflationary challenge is there, and some of the other central banks across the globe have already started hinting that in view of rising inflation, say for example in US, the inflation is 7%, which is at a 40-year high. And the FOMC, though, did not raise the rate in its December meeting, but the the survey which is done amongst the Fed members clearly indicated that 12 out of 18 members, FOMC members, expect at least 3 rate hikes in fiscal year 22. So this clearly indicates that inflation is something which may force the central governments to get out of the loose monetary policy and then start normalizing it. In India, also, given the fact that mostly the anchor, which is the retail inflation for RBI's policy, is mostly closer to the upper band. So the expectation is that RBI may actually do that. But the way the growth is panning out, and given that a large part of demand gets stimulated because of the low rate of interest, and also the Capex, I doubt that RBI will, again be in a hurry to do that. So at least I don't see it happening in the February policy review, and also the next RBI will do anything on that front. And on top of that, as we showed that in YOY terms, the rate of inflation is likely to be lower in fiscal year 22. So all of that will provide cushion for RBI to hold on to the policy rate for a longer period of time.
Follow-up question, Arup, just hold on because Bani has had a big question. So I am, rather than asking entire question at one go, I am asking in bits and pieces. So Bani, CAD 23, we are saying 2.3% of the GDP. And Sunil, if you want to take it, he's asking whether net export will have a worse drawdown effect on GDP growth in 23. The answer is yes, unless Sunil, you want to expand.
No, you go ahead.
Yeah. So Bani, 2.3 is for FY23, 1.7% of the GDP, current account deficit 1.7% for FY22, 2.3 for FY23, larger current account deficit, because when you look at national income identity, it is export minus import, which is nothing but CAD. If we have a higher CAD, it's a drawdown effect on the GDP. Anything else on this? No. Okay. Arup, please go ahead.
Good afternoon. Good afternoon, everyone.
Yeah.
I would like to know from Dr. Sinha and Dr. Pant, what is India Ratings' view on private household consumption or demand in the coming fiscal? Because in the press release that was issued before this webinar, on one hand, the India Ratings is saying that there are continued weakness in private consumption and investment demand is estimated to contribute XX% to this shortfall. And then on the other hand, in the table below, private final consumption expenditure is shown to be growing 9.4% in FY23, which is higher than all the data that has been put out from FY 2014. So what is the view on household income and household consumption in FY23? To what extent will it rebound?
Okay, Arup, look, the first thing which we are saying, like weakness in household consumption has contributed 43% to the decline in growth. So basically what we are talking about is had there been no COVID in 21, 1, 2, 3, whatever, the economy would have grown in the past trend rate of growth, then the gap between past trend growth rate and the where we are in FY22, that is 10.2%. So we are 10.2% below the trend in FY22. That's the size of GDP. Now, in the 10.2% reduction, the major contribution has come from the private consumption expenditure. So private consumption expenditure has contributed 43% to it. Now, if you look at the table, which is there in the press release also, in 20 we were, FY20, the private final consumption expenditure growth was 5.5%. In 21, it declined by 9.1%. FY22, the NSO expects it to the 6.9, right? So basically in 22, we have not yet reached FY20 level. So in 23, we are expecting it to grow to 9.4. That will, because of even the base is much, much lower than FY22, the 23 numbers are giving you an inflated number of higher expenditure growth.
All right.
Why? This is again base effect.
Base effect.
Understood. All right. Thank you. That answers my question.
So any other participants has any question? I don't. So back to you, Ankur.
Thank you, sir. And I believe with that, it is time for us to conclude this conference. Ladies and gentlemen, in case you have any further queries, please write to us on the email ID mentioned in the chat box, or you can reach out to Dr. Pant and Dr. Sinha directly. Thank you once again for joining us, and have a nice day.
Thank you.
Thank you. Thanks, everyone.
Thanks, everyone.